Welcome to Gold Silver Pros.
Everybody, it's Rob Keynes with 𝑔oldsilverpros.com, and I have a returning guest of the program. Somebody hadn't been on the channel in a while. This is Dave Kranzler of Investment Research Dynamics, and we're recording on the 11th of January 2024. Dave, how are you doing today?
I'm doing well. How about you, Rob? Good to see you.
Yeah, not too bad. It's an interesting market. Of course, we were talking, I'll get weather just a little bit before we get into the markets.
Yeah, you got to start with weather, right?
Yeah. So we're talking about the polar vortex is coming, and it looks like it's going to be interesting. Of course, anytime anything happens in Texas, everything gets shut down. We're not prepared for the deep winter storms. What's it looking like where you are up there in Colorado? Do you think there's going to be, pretty good amount of snowfall and shutdowns and stuff like that?
I think it's going to be too cold to snow. On Monday, it's supposed to hit starting Saturday. And on Monday, I think the forecast high right now is 0.
Okay.
Yeah. So when I was growing up, they wouldn't shut down the schools for that, but I think they'll probably shut down the schools, but everything else will operate.
Yeah. Well, along with the polar vortex, I've said transitioning into the economy, I think in 2024, we're going to have our own sort of vortex. I think my view is that we're going to have a lot of choppiness. I think we'll have more swings in the markets. We've already seen it with Bitcoin and gold already. I think gold reached a new all-time high a few weeks ago and opened on a Sunday and then got slammed down over $100 in a day. And generally, when you get to that point of the market with the alternative currencies, it's signaling people wanting to come into them, but there's not enough momentum really to push them, into that last phase of the market. But I think it does signify, Dave, that people are seeing risk and they're starting to take account of these alternative assets. What's your view on that? What do you think? Just give us a real quick little preview of 2024. What do you think we're going to see this year?
Well, as you say, I think there's going to be a systemic vortex that hits. It's going to affect the economy. It's going to affect the financial system, the banking system. I think it could get really ugly this year. And for me, it's just a matter of when will the Fed start printing money overtly again. I mean, as we were discussing, it's already been injecting reserves into the banking system since February. So, and they know what's going on. I mean, it's fun to laugh at the FOMC. Well, I don't know about all the FOMC members, but it's, Powell gets informed from the research staff at the Fed what's going on. I mean, they have access to better data than any of us, and so they well know what's going on. And so then it's just a question of how do you package what the Fed communicates? And Greenspan was the master of it. But how do you package what the Fed communicates so that the dollar doesn't get flushed down the toilet and interest rates go to the moon, right? And we saw today, I don't think we're done with inflation at all. I mean,
no.
We'll never be done with their willingness to massage away actual inflation from the CPI report. But the CPI report hasn't been designed to measure real price inflation since the 80s. So, regardless of what the CPI report says, and if they were not able to keep that headline number below what Wall Street was forecasting, like happened today, it tells you that inflation's running a lot hotter than even they have the ability to massage it out of the numbers and maintain some semblance of credibility.
Yeah, I think the inflation story is far from over. If you go back and look at the 70s, it had three stages, each one more than the other, where you got the blow off top, and then Volcker was forced to come in and raise interest rates. I think it was somewhere between 18 and 20%, just like overnight. And John Exter was one of Exter's Pyramid, was one of those people who was counseling him to do that, because back then he had experience with the central bank, also being a central bank head of another central bank, and he was telling Volcker, he's like, hey man, you got to get control of this, or you could have a runaway inflation of the dollar. And Dave, that was back before we have so many damn dollars all over the place. Now, fast forward to today, we're all, you could wrap your Christmas presents in how much dollars we've created. I agree with you. I don't think inflation's anywhere near ending, and we've started to see those hot prints come back. We started to see it a couple months ago, just touch, go up a bit. And now I think we're starting to see it for real. Can the Fed cut, when if inflation's going to come back, even if it doesn't get to almost double digits like last time, maybe even it just goes back up to 7, 8. Do you think the Fed can do their planned cuts that they're talking about? They kind of signaled the market we may do 3 to 4 cuts this year. Do you think they're going to be able to do that?
I mean, there's a couple factors going on there. I mean, just to kind of get back to what I'm expecting in 2024, I think the economy is and has been in worse shape than the official numbers show. I mean, especially, I scour private sector earnings reports, data, economic reports for my short sellers journal every week. And what the private sector is reporting is a lot different than what the government numbers like GDP and employment are showing. So yeah. I think the economy is in not great shape, and I think it's going to get a lot worse in 2024. And the primary reason for that is that households are just overstrapped with debt. I mean, we saw that in the holiday season, where holiday sales were if you strip out price inflation, holiday sales actually were probably negative on a year-over-year basis. And yet, based on the November consumer credit report from the Fed, credit card debt increased in the month of November by the second most in history on record.
That's right. And the revolving part of that debt.
Yeah.
Over 19 billion. Yeah.
Yep. And that's a sign right there.
You got the buy now, pay later plans, Dave. So
yes.
You're right on that. Yeah.
Yeah, you're right. And that's another indication, these people using, the buy now, pay later, it tells you they didn't have the money to fund their holiday gifts. Mm-hmm. And now they're going to have to spend a large part of 2024 paying that debt down. That's expensive debt. That buy now, pay later debt is in the mid 20s%. And so that essentially that robs consumer spending from 2024 and pulls it into the holiday season, which was weak as it was. And so, I think the economy is really going to go into a downward spiral this year. And so can the Fed cut interest rates? I mean, I think it depends on the degree to which it wants to try to save the economy, at the expense of the dollar. So let's just put it this way. I mean, they're in a much tougher position than the Fed was in 2008, if you ask me, and probably even in a tougher position than that pandemic period. So and some of the private sector economic data indices are now back down to where they were at the bottom of the pandemic, during the lockdown period. So that kind of tells you where we are. And so how is the Fed going to treat that? I think, like I said, I know we were talking earlier, I think it's either, start printing money and cut interest rates, or cause the economy to really crash and default on the government debt.
Yeah, those aren't great choices. And in addition, in addition to what you said, a lot of the GDP, because we had some fairly robust GDP gains, in the last couple of months of the last quarter last year. We had a 5.2 and a 4.9, something like that. But if you dive beneath the numbers there, the majority of it was government spending. So it's all debt-based. Defense spending, government spending, and then the consumer spent more, but we just went over how they spent it. They spent it on credit. Yeah. So that GDP gain is, as you said, it's a debt that must be paid back later. So it's not additive to the economy. It's something you're going to take back, because it's whatever you spent plus the interest rate you have to pay is now going to be drawn out of the economy this year as people pay it back. That's right. And we got the unemployment numbers. Let's talk about those for a minute. The unemployment numbers, every single time they come out, they get revised down. So it's never as rosy as they say, but Zero Hedge does a really good job of breaking down the mix of jobs. So in was it November's report, or the latest report we got, or December, I'm sorry, we lost 1.5 million full-time jobs and we gained part-time jobs, but we're not making up for the income and the benefits and stuff like that. So how do you think that affects consumers in 2024?
Well, I mean, yeah, I actually dissected those numbers in my newsletter last weekend. Mm-hmm. The interesting thing is that the 216K number, the headline number, mm-hmm. that came from the establishment survey. right? There's two surveys. I mean, it's just stupid how they do this. Two surveys. That the household report, I can't find it in here, but the household report showed, oh yeah, the number of people employed declined by 683,000.
Yes.
And so the part-time workers increased by 579,000, which means if you do the math, full-time workers fell by 1.26 million.
Yeah.
And a high percentage of those additional part-time jobs are people taking on second and third part-time jobs to make ends meet. And so, when you see, 216K new jobs in December, the economy must be doing well. That's better than expected. Well, no, that number is completely fictitious. So, yeah, I mean, this is all feeding into what I think is going to happen this year, which is, and we haven't really begun to see the real layoffs coming. So, and that's coming. And we're also going to people are going to start defaulting on their debt. It's already starting. So, I mean, the delinquency rate on credit card debt for all of banks in the US except the top 100 is over 7% now. Now you're getting into 2008, 2009 numbers. Yeah. And it'll start rising at the largest banks. Just give it some time.
Yeah, it will. So I think, all of this is circling around the point that the banking sector probably is going to have all sorts of trouble. One of the recent reports is that the amount of unrealized losses on the bank's balance sheet is the highest it's been in forever. In fact, the chart I saw is as high as it's been since the chart's been kept, at least over the last 10 years. And those unrealized losses are really essentially what put Silvergate, SVB, First Republic, all of those banks out and almost took out Credit Suisse. Because if you mark to market the value of the debt, quote unquote, assets, like mortgage debt, treasury debt, it's debt, but it's an asset, right? That old stupid game. But if you market to market, a lot more banks are insolvent. Bank of America is probably the first one because they have a third of all of this by themselves.
Yes.
At what point does the market, it did for Silvergate and SVB. At what point do the smart people in the market, the sharps, turn around and look at the rest of these banks and say, oh crap, we're in much worse shape? And then it starts some sort of bank run, whether it be on the depositor side or on the investor side. Because I think the Silvergate and SVB, it started on the investor side and moved to the depositors. The investors figured it out, and then they started withdrawing their money. How long before that happens to the rest of the banking system? Could that happen this year? Or is that something you think that people just aren't going to touch it?
That's a great question. I mean, really, you're just making the argument for why the Fed will probably end up cutting interest rates, because the problem with these banks is they had a duration mismatch between the duration of their liabilities, which are demand deposits. You can walk into a bank and say, I want my money, versus the duration of their, what they call hold to maturity assets. And that was just an accounting game that was put in so that banks, if they hold assets, and they go down, they used to have to mark them to market, even though it was just paper losses. Well, they decided, well, why don't we move these into hold to maturity category, and that way we'll just carry them at face. And they're long duration assets, which the banks piled into because they couldn't get any yield on the short end. And they didn't. It also tells you that for the last few years, there weren't enough good projects to lend to, right? I mean, that's what the banks do. They take in deposits and lend money to whatever, and unfortunately, too much commercial real estate. But so you have these assets, which are, arguably very high quality, that don't mature and, until 7 to 10 years from now. And when rates shot up, the value of those assets went down, 20, 25%. And so that's where the problem was. And that means that, I mean, the Fed can try to fix it by jawboning rates lower. And I think that's what we saw in the last FOMC meeting. And I think that's what their motive was to try and get rates down at the long end, which it did. I mean, we had a quick 100 basis point retracement in yields lower, right? And that helps push up the value of the fixed income assets held by these banks. So, and if they cut, the interesting thing is what happens if they do cut rates, or when they start cutting rates, we could actually see the yield curve steepen, which will make the hold to maturity valuation problem even worse.
Yeah, it would. And let's get into some of the indicators of trouble. So I'm going to throw out three. We've got the yield curve inversion that we've had now for at least 6-7 months between the 2 and the 10-year Treasury. We have the bank term funding program, and we have the repo market. So let's start with the first one. What are your thoughts on that?
Well, my thoughts diverge from what the mainstream media experts are telling everyone. Oh, an inverted yield curve doesn't mean anything anymore. We're having a soft landing. We might not even land. I mean, it's been inverted for a lot longer than 6 months, and I don't have the number off the top of my head for how long it's been inverted. But historically, unmitigatingly, an inverted yield curve for that length of time, and I'm not even sure it's ever been inverted for as long as it has been. I'd have to look that up.
I don't think it has.
Yeah, it always signals recession.
Yeah, this is the longest it's ever been inverted, prior to a recession, and it has 100% prediction rate on recession so far. Limited sample size, but it's been a really good indicator.
You could argue that this, several sectors of the economy have been in a recession for over a year. I mean, you've seen it with the leading indicators. The leading indicators index has been declining for 19 months. It's been negative for 19 months. Same with the Dallas Fed Manufacturing Index, like 20 months or something like that. Manufacturing has been in a recession for over a year. Retail, if you strip out inflation, is barely treading water. So, that's right. I mean, no one in the mainstream would ever admit it. But I mean, if just looking at the numbers, I mean, there hasn't been any real economic growth, especially if you use a real deflator to measure GDP. There hasn't been real economic growth in a long time.
Yeah, I agree with you. I don't think we've had any true sustained economic growth since the last recession. And honestly, Dave, if you look at the numbers, I can make the case that going back to the tech crash, whatever gains we had ever made after that are long gone. And the bill that we have to pay for maintaining basically an even, for the last 20 some years is yet to be paid. All the money we spent was just to keep it even for all intents and purposes, but we still got to pay the bill at some point.
Right.
So I think people will come back to this 20-year period of history and say, yeah, that definitely was not worth it in terms of the amount of destruction done after going on these wild, insane policies. And we tried them all. It's all modern monetary theory that they're trying.
Yeah.
And I think it's going to fail. Let's get to the other two that I mentioned, the repo market and bank term funding. I think we made an interesting connection before the recording that bank term funding program and repo are sort of analogous to one another. And the repo market liquidities come down, interest rates are above 5 now. And I noticed as soon as that repo market rate went above 5, the amount of collateral pledged to the repo market has fallen off a cliff. It's like people don't want to pay that rate for short-term funding. Some banks are using like bank term funding or the farm legislation to go pledge collateral to get money from the Fed. Aren't these similar schemes in order to keep a certain amount of liquidity in the banking system and to kind of cover up, what is looked at as maybe not super high quality debt and super high quality, collateral that's being used?
No question about it. I mean, just take the bank term funding program. How is that not QE? I mean, definitionally, that's what it is, right? Yeah. These banks pledge their collateral, the hold to maturity securities. They pledge that as collateral, take it to the Fed window, and get a loan against that.
Yeah.
And the incredible thing is the Fed is lending on face value as opposed to the 15 to 20% discount to face where it's trading now. So, I mean, that's what QE is, right? I mean, even an overnight repo is, at what point does it become not an overnight repo in QE? Does it have to be a 10-day maturity, repo maturity, a 1-year repo maturity, and they don't, the thing is, these banks don't have to pay back the money that they're taking from the BTFP right away. It just means supposedly this March date is when you can no longer tap into it. But that doesn't mean you got to pay it back all at once. So,
right.
and I guarantee the Feds either they're going to let the banks, keep that liquidity for as long as they need it, or it'll extend the window on that facility. They'll probably extend it out. They'll say 6 months, but it's like that repo program that started in 2019, September 2019. And I could see from the numbers I look at that the banks were becoming illiquid in the summer of 2019. And if you
Exactly,
go back
they were, yes.
yeah. And if you go back and look at the bank stock charts, they started selling off in August. So, what was a temporary overnight repo program slowly transitioned and then quickly transitioned into, multi-month repo maturities. And I forget how big it was. It was huge by the time they decided to just print $3 trillion all at once and throw it into the banking system.
Do you think we've for years, I think, in our industry in general, not just us, but in general, if you follow gold and silver, you follow the economy, you follow Austrian economic, that type of thing, you're always looking for what is the trigger, what's the black swan, what's going to cause it. Is it ultimately always coming down to the banks and the central bank? Isn't that always what we're talking about? Will that be what we've been talking about, what eventually will cause this thing to topple over? Is it the dollar? What is it? What do you think is going to topple it finally?
Well, if we could figure out what it was, it wouldn't be a black swan definitionally, right? So I don't know if you saw it. Someone tweeted, I don't know, it might have been over the weekend, his list of what the black swans would be in 2024. And he had a whole list of things, some of the ones that we're talking about. I'm like, well, how are they black swans if you already know that they're there, right? I mean,
maybe we already know the answers to the test and we're just sitting here waiting.
That could be also. That very well could be. I don't know. I mean, I'm starting to get a little bit nervous about what's going on in the Middle East. I mean, it looks like it's starting to escalate. And
man,
you know what? I don't know if you saw this.
Yeah.
I mean, I can't believe this government is going to do this. But the White House apparently is backing legislation in Congress to use the funds, the Russian funds that the U.S. confiscated to rebuild Ukraine.
Yeah.
Now, I mean, we know there's like half of that's going to end up in the pockets of the contractors that go in there, the U.S.-based contractors that go in there and do the building. But I honestly can't believe that this country is arrogant enough to think that it's going to actually take those funds and use them for its own purposes. Outright theft, right?
Yeah.
I mean, you could argue that it's not officially theft yet. It just Russia doesn't have access to those funds. But if the U.S. goes and uses those funds, that's outright theft. And if the people in D.C. think there won't be repercussions to that, I mean, look what's already happened to the precious metal sector since the confiscation began, right? I mean, look how much gold the Eastern Hemisphere has been acquiring over the last 2 years. Phenomenal.
Yeah, that's something I want to talk about. So let's talk about the war for just a sec. And let's get into gold, silver, if that's okay. You brought up the war, so I want to focus on it. I tell you, every time I bring this up, especially on Twitter, I get hammered because there seems to be, Dave, and I'm not trying to make this political, but there seems to be a certain group of people that want us to go blow up the Middle East. And any excuse that we can do it, it's like kill them all and let God sort them out. And I kind of get that you have an affiliation with Israel because of the United States' long standing. But at some point, when do we say this is less about our supporting Israel and more about us not wanting to start World War III? Because now you have Houthi rebels shooting off rockets from Yemen at our destroyers. Now we've got a couple of destroyers over there. Then you have Iran chasing out our warships. None of this is good. In my opinion, we don't want to go over there starting any sort of crap, Dave, because I don't know that the crap that we start is not going to then push over into other nations we don't want to F with. I don't want to F with China. I don't want to F with Russia right now. But I feel like we're almost drawing some of these bigger powers into it. It's, my master's in military college, and when I went to residency, there was one of the professors talking about proxy wars. We're in this big proxy war. I don't want this proxy war to spill over into a war. That's my fear. Do you think that that's possible, or do you think there's no chance that happens?
I mean, is it really a proxy war? It almost seems like a direct war. I mean, we've got
very close. Yeah.
Yeah. I don't know if we have boots on the ground over the Middle East, but if we've got boots on the ground, I mean, it's already war, if you ask me. Yeah. I mean, my opinion is I don't think the U.S. should be over there. Period. You know, let that region of the world sort it out, and you know, the less intervention that you have, the more quickly and efficiently it'll get sorted out. But I mean, you know, war is money, right? Defense companies are making a bloody fortune in Ukraine. They're now going to be making a bloody fortune in the United States. I mean, in Israel. It distracts people away from, you know, if you've got war in the headlines, you know, it distracts people away from all the other BS that's going on in this country right now. You know, especially the border. I mean, the border. I mean, you could call that a black swan. I mean, it's gotten out of control, as you well know.
Yeah, the amount of, and there's so much talk about, Dave. I feel like we could go on forever. So I'll talk about it for a second. I'll move to gold and silver, though. The board, I call it an invasion, which offends a lot of people, but they're literally just pushing people through, and they're not even qualifying them, and they're giving them money, and they're giving them gift cards and cell phones. We now have this on film, so this is not conspiracy theory. We have it on film. We have sheriffs in Texas and Arizona saying this is happening. They're literally just shoving people in the country. And what happened to Europe when that happened? Well, Europe culturally became very politically unstable.
Yeah.
And I think that cultural instability is coming to the United States in some regard, because it's okay to have immigration, but when you do it the way you're doing it, it's going to cause instability. The system itself can't handle it. Whether morally, you know, whatever argument you make there, economically, it's going to be a disaster. It's already a disaster. The state of Texas is calling special sessions because we only do every other year. Odd number of years we do our legislature. We're not supposed to be in session for 2024. We're in special session talking about this issue. And no matter what Governor Abbott does, he signs letters saying, I'm going to take care of it, but we just don't have the money. You know, we can't cover all the thousands of miles of our border space, you know, that don't have fences. There's literally, I mean, there's nothing we can do about it. There's nothing state of Texas can do. Arizona seems to be helping and paying for all this, or at least some of it. Yeah, that's a nasty little, that could be a nasty little black swan that we have. And what is that thought that most empires collapse from the inside? Maybe that's really where it's going to come from.
Well, I mean, and you know, Abbott's been sending a lot of them up to Denver, you know, to other sanctuary cities. And I just saw there's the state of Colorado is going to allocate $12 billion in taxpayer money for housing for these people.
Yeah.
And I mean, I kind of think, I mean, one way to at least slow it down is to stop providing economic incentive for them to come here. You know, don't hand out money that we don't have to give them cell phones and food cards and shelter, right?
Yeah.
I mean, they're not going to have much fun this weekend in Denver, I'll tell you that, unless they have shelter. But it's like, I think, as you pointed out, and what happened in Europe is that I think you could see a major social backlash against this.
Yeah.
And that could be coming this year if they don't do something to at least slow it down and stop allocating, you know, taxpayer money to clothe and feed and shelter these people, money that we don't have, right? I mean, we're giving them money that we're borrowing, whether it's from foreign investors or, you know, the Fed has to print it up.
Yeah, that's right. Okay, let's go to gold and silver. So gold hit a new all-time high a few weeks ago on a Sunday open, then got slammed the next 2 days. When you go look at the COT report, it was the bullion banks. We know who the culprits always are. We know who they are. If you combine the COT report with the Office's Comptroller Currency report, we know the 4 banks. They're called out in the OCC report. So we know who the culprits are. Do you think at some point gold and silver are going to get up and run and just keep running? That at some point they lose? 'Cause I've always thought that they're going to lose control. I've said it all these years, but they seem to have immense power in the short term. They can stop short rallies. What do you think is going to get gold and silver over that hump to just keep running like it did, 2009?
Well, I mean, to your point, since 2001, gold is still the best performing asset, right? It's outperformed even, the Dow and the NASDAQ and the S&P. So, it's back in the earlier days, early 2000s, we used to refer to it as a controlled retreat, the price management of gold. And, again, it's, you see the price management happen when it's just the London and New York paper derivative markets that are open, right? You don't, it's not like, these Eastern Hemisphere banks that have been accumulating a boatload of gold over the last few years. It's not like they're out there selling chunks of physical gold on the market. Once people buy physical gold, they keep it.
Right.
They use it as collateral. So it's clearly all being engineered in the derivatives market. So what'll cause them to lose control? I mean, I think that's part of why the Fed is being so cagey about. I mean, we know the Fed at some point is going to have to start cutting rates and printing money.
Yeah.
And I think part of the reason they're being cagey about it is to help them control the gold price. I mean, that's what we saw in 2008. I mean, gold was over $1,000 in March as Bear Stearns was going bankrupt that year. And then by the end of October, gold was down at 700, even though everyone knew that the financial system was blowing up. And that's the type of thing that should cause gold to double, not go down 35%. So I think that's kind of what they're doing now. I think they know that at some point they're going to have to start printing money again, cutting rates. And I think they want the next launch in the prices of gold and silver to start from a lower level than if they were not trying to control the price. You see what I'm saying?
Right.
And, I mean, it's just like that list of black swans that went around on Twitter. I mean, there's any number of trigger events that could cause it to happen. And I think we will see one or many of those trigger events this year.
Let's move over into the stocks real quick. It seemed as though the mining stock indices kind of got off the mat a little bit in the fourth quarter, showed some life. I don't know if it's a Rocky Balboa story just yet. It seems like they may have fallen back down. What do you think? Do you think we're going to get the catalyst from the step? What the catalyst to me is being where gold's right now. Gold needs to go back to a new all-time high and stay there. And then to me, I think the mining stocks get up, and they start fighting again. Is that your view, or what do you think is going to propel the mining stocks back into, another bull cycle like we saw in 2016 and in 2020?
That's a really good question. It's kind of an interesting answer because, if you go through the exercise, I run 2-year charts on my stock trading app. I use GLD and SLV and GDX, and GDX, and actually all of them, gold and silver and, the large cap mining stocks have been in an uptrend since September 2022. I mean, you can just pull up the chart and see.
Yeah.
So, and I mean, since the beginning of October, and again, this number's off the top of my head, I calculated it the other day. GDX was up something like, 35% in the fourth quarter.
Yeah.
And so, I mean, it's natural to have a pullback, a corrective pullback, because it was starting to get frothy. I'm looking at the chart here, and the RSI was in way overbought territory by late November. So late November, by beginning of December, it was overbought. So it kind of, you kind of knew there was going to be some kind of pullback. And I think it's the kind of pullback that'll set up the next move higher. I think where our people, meaning, the cohort of people who invest in mining stocks, I think they really more focus on the junior project development stocks. And those are the ones that have been stuck in mud now for a few years.
Yeah.
And so for me, the question is, And you're right, to your point, GDX, the Amex Gold Bugs Index, which I guess is called the ARCA Gold Bugs Index now, they're all extremely if you run the ratio charts, they're extremely cheap on a historical basis relative to the price of gold. So,
right.
So then the question is, when will they catch up with gold? And I think we could see that this year again. Any number of trigger events that'll cause gold to shoot up into an all-time high and maintain that level, and silver at some point's got to catch up to gold. I mean, silver's going to be in a supply deficit this year, right? A supply demand deficit. At some point, silver will catch up. But if we could see silver start to move into the high 20s and get over 30, I mean, I think we're going to be off to the races in the mining stocks, and especially the micro cap junior project development stocks. Those are the ones you really want to be in if it unfolds this way. I mean, nothing's guaranteed.
Right. Do you think 2024 is going to be a catalyst year, or do you think this can keep going for you? Because we're in an election year, and in 2008 was an election year, and they couldn't keep everything going to the election. We actually had problems before. Do you think in 2024 they're going to be able to keep it together? Do they want to keep it together? Is the Fed care at all at this point, or is the Fed just trying to bail water out of the boat as fast as possible?
I mean, they've already, as we were discussing before we started recording, there's already been low grade, call it money printing, going on since February, right? The base money supply is up over 7% since February. And thus it's banked. They've been creating bank reserves, right? Because the base money supply is bank reserves plus coin and currency in circulation. So there's already been kind of a low grade version of money printing going on since February. And the question is, I mean, one thing that we didn't touch upon, it's probably a whole topic unto itself, is you've got debt maturity wall in commercial real estate. And not just commercial real estate. What doesn't get talked about is these private equity funds levered the crap out of all the companies that they took private over the last 3 or 4 years. And there's going to be a maturity wall there. And a lot of these companies, they're going to have trouble refinancing them because they don't make money. Interest rates are a lot higher than when the debt was issued. And the banks are sitting on a lot of this paper. So to me, it all kind of boils down to, in terms of printing money, well, there's two facets. Do the banks come completely unraveled this year? I think I'm not saying it's going to happen. I think there's a good probability that they will, but also there's going to be a lot of new treasury issuance that has to come. And when that reverse repo facility gets to a certain point, and that's mostly money market funds, when it gets to a certain point, they're not going to be able to, roll over debt and finance the spending deficit by issuing T-bills. That's what they've been doing since they removed the debt ceiling. At some point, they're going to have to start issuing longer duration paper, which makes more sense anyway, because it's trading, at a considerably lower rate than T-bills are. And it's like, who's going to buy that stuff?
Yellen got a lot of criticism for not promoting that already. I remember in the last month, the market really got onto her for not being more active in the longer, the whole government complex not being more active in the longer term debt market.
There's a reason for that, though. They don't have a problem getting auctions that are less than 5 years done.
Yeah.
But there's been some hiccups in the auctions in the 10s, 20s, and 30s, especially the 20s when they've issued 20-year paper, because, and again, this was the case, 4 weeks ago. I haven't looked at the curve lately, but at that point, the 20-year was trading at a lower yield than the 30-year. And so it's like, why would you want to buy the 20-year?
Yeah, it seems as though the longer end of the curve, people aren't buying. So I think what's happening is people aren't buying the long-term stability of the dollar and of the U.S. economic system. They may take short-term debt because they perceive that they can get out of it,
And especially foreigners, they're pulling away from that. So, if they're going to start issuing on the long end, they're going to have a hard time holding rates down at the long end, because they're going to have to find a rate that'll clear the market at the long end once the money market funds are out of cash to keep the gerbil on the treadmill with T-bills.
Yeah, it seems as though it's like a sort of a, not a pincer, but the Fed's boxed in, and
big time.
The Fed and the Treasury don't have the tools to get out of this one. They don't have the liquidity. They can't get enough liquidity in the system. Like I said, they can't go to the long end of the curve. They can't push out and de-risk the system. And when you can't do that, you're in a box, and then everybody jumping out of the system, that box is not supported. To me, there's no way out. I think this is the no way out scenario. This is the
print.
Yeah.
That's
hyperinflate, right?
That's going to be, they either print or default. So,
and they won't default. They've already said default is not an option.
So pick your poison. So that means they're going to print. And then the question is, does all this come to a head this year, or can they kick the can down the road somehow for another year? I mean, that's the $64,000 question. I mean, I think there's a high probability it comes to a head this year, but they may have, believe me, the brains at the Fed, they discuss what we're discussing with better data. So they're well aware of the problems. Yeah. And so then it's just a question of how do you package it when you have to roll out the solution, which will be money printing.
Do you think the foreign debt holders have become the marginal buyers, and when they walk away from the table is when it collapses? Because
they're already starting to walk away from the table, right? They're already starting to walk away from the table.
But I mean, when they finally get up and they're not even at the table anymore,
which
I think is coming because they're developing their own systems. It started with trade, then it went to transfer, and then it went to currency. So the writing's on the wall. They're developing their own economic system. At what point do they get up and walk away? And when they walk away, is that collapsing? Because once the Fed is 100% monetizing everything, then everybody knows the jig's up at that point. Yeah.
Yeah. I mean, I think getting rid of the dollar is going to take a lot longer than a lot of us would like to think it would.
Yeah.
But, again, it's the question of to what extent are the foreigners willing to continue feeding at the Treasury trough? And we see they're already pulling away. I think at this point, there's probably a rate that would induce, not all of them, but enough to bridge the gap, in funding the deficit. But that rate, I think, is it's got to be closer to 10% than where we are right now. And that's the problem, is that, 4% on the long bond is not it's not an economic rate. It's not a free market rate. And
because your opportunity cost is what you can get in the emerging market. The emerging market returns are higher right now.
Right.
So if you look at BRICS projects, if you look at Belt and Road initiatives, if you look at outside the Western system, the development of blockchain projects and the digital economy, there's much higher rates of return outside the U.S. than there is in the U.S. right now, I think, at least from a debt perspective.
Right. Well, and again, as we've been talking about, a lot of these central banks and sovereigns are putting money that they might otherwise put in, or historically put into treasuries. They're buying gold with it, physical gold.
So any last thoughts, Dave, before we wrap up and talk about your newsletters? Anything we haven't covered on the program that you've been talking about with your subscribers that you want to share?
It's interestingly, I usually, when we get pullback cycles like this, I get a much higher rate of cancellation than I've been getting really for the last 2 years. I mean, I've had a drawdown in my subscriber base, but I'm still getting new subscribers, and most of my long-term hardcore subscribers, I mean, they remain rock solid. They firmly believe in this sector, and they firmly believe that there's at some point alpha to be earned in this sector. So I guess I'm just kind of surprised that I haven't been getting more cancellations during this pullback. And really, we've been in a pullback period since, GDX was much higher back in March of 2022 than it is now. So, there's a lot of frustrated people out there, but I think I think the reward should happen this year, could happen this year, and if not this year, next year.
All right, very good. So tell us, Dave, about investment research dynamics and the 2 newsletters that you write and how people can get in contact with you if you're interested in taking a look at those.
Sure. So investment research dynamics, that's my blog. I don't post as actively as I used to, but I'm going to try and crank that back up again. And at the top of that, there's links to my mining stock journal, which comes out twice a month, and my short sellers journal, which is a weekly. And you can get more information on those 2 newsletters. Just follow the links.
Perfect. Sounds good. And a reminder for those of you that follow me, we do have a bullion store, and we have a couple of deals out this week. We're $2.99 per ounce over spot for silver maples, and I think we're $2.75 over spot for the UK Britannias. If you want that or any other discounts, you can find on our discounts page.
Those are good deals.
Thank you. Go to www.goldsilverpros.com. Go to the discounts tab. We have prices on just about anything that you want. But if you want those 2 specific deals I gave you, which aren't anywhere on the website, you click on access discounts here, fill out the form, and I'll get in contact with you. We still do this week. I'm also giving away a couple of freebies, a couple of proof coin sets with the first amount of people that order. I think I've got a couple of those left. So if you're interested in getting a free proof set and you buy at least $500, we'll do that as well. All right. Thank you, Dave, so much. We appreciate it. And welcome back to the program. Nice talking to you. I know it's been a while.
Likewise. Thanks for having me back on.
Yeah, we'd love to have you come back in rotation again for this year if you're interested, for sure.
Just let me know.
All right. Sounds good. Thank you, Dave. I appreciate it.